Hmm.
Hi,
Hey, Fabian. Hi, how are you?
good. How are you? I hope the internet connection today is better.
Good, good. Okay, well, that's good to hope for.
Yeah,
So let's wait just a couple more minutes and see if anyone else will join us. So far, it's
sure.
just you and I. So if you had a chance to look at the Caledonia case,
Yeah, very briefly only. I've been kind of sick the last days. I got like a cold with coughing and like my nose was really congested, and
right?
so I wasn't really able to do anything um in terms of that, just because I had a headache the entire time, and I was like slowly getting better after taking some medicine. But
Sure. Totally understand. Not a problem. Um, I wanted to be able to share that I got an image of the case, which I think I sent out to everybody too.
yeah, I saw that.
Good, good. I want to see if I can maybe share that or cut and paste it to a Word document and share that. Just, so I can flip between the spreadsheet, which I do have up on the share now, I think.
Right.
And
I think you could also like you could potentially also paste it into the spreadsheet as well. I think that's also possible.
okay, let's see first if I do it this way, so I have two separate documents. Um, okay, if I make that a little larger here. Okay, chopping off some of it. Either that or I'll just ask you to, call it up there, um, just so you can refer to it as we go back and forth in our discussion.
Yeah.
Yeah, why don't you call up? I would call up both the case itself, the image that I sent out, or whatever you have, and the spreadsheet too on it on Caledonia. Um, and let's just see now if I can. Can you can am I sharing the case with you now?
Yeah.
Okay, good. So we have that. And now let me just see if I want to jump back to an Excel sheet. I've got too many windows open now. No, I'm trying to share the sheet. Can you see the sheet itself now?
Yeah.
Yeah.
Good. Okay. Well, I'm not sure if anyone else is going to join us. Wait a minute, though. I see a couple more people. We got Aaron, good, and Nina, good. Okay, great. So we have a few folks here. And as we only really have five students in this course, I always like to keep mentioning that, how personal it is. Anyway, we have a quorum here pretty much. with Aaron and you, Fabian, and Nina being with us. So welcome everyone. Hi, Aaron. How are you?
Not too bad. How are you, Sue?
I'm well, thanks. Actually, I'm a little under the weather today, but I'm hoping we can get through the Caledonia example case that I really want to share with everyone, and then maybe turn everybody loose in you know 40, 45 minutes or however long it takes us to go through this. But anyway, I'm doing okay. I mean, it's not like it's anything major. I'm fine. Nina, how are you?
I'm good. Yeah,
Good. Good to see you. Welcome again. And I will be
thanks.
seeing all three of you again later on today with our 470 meeting, which should be a little bit of some fun as well. But anyway, let's get started on this Caledonia case, which I think is a nice example and is going to be very much like the Franklin lumber case that you'll be working on this week and which is due on Sunday. So I'm going to flip back now to sharing um, sharing the case image that I've got here somewhere. So let me just go to this. Okay, and just bear with me while I read through this, but I'm sure all of you have taken a little bit of a peek at it anyway. But and also as you'll notice, this is very similar to what is laid out in the Franklin lumber case too. So obviously that's why we're going through it today. But anyway, they're saying that it's been about 2 months, okay, since you've taken a position as an assistant financial analyst at Caledonia Products, and they're kind of laying the the groundwork here for the nature of the case and the reason for all the questions. And so they're saying that although your boss has been pleased with your work, um, he's still a bit hesitant about unleashing you without supervision. Obviously, they're still waiting for the junior financial analyst here, which is going to be all of you folks, to to prove your skills and be trusted to work without supervision. So anyway, they're going to have some questions associated with this that they're going to guide you along the way in analyzing the Caledonia case. So they're saying the next assignment involves, both the calculation of the cash flows associated with a new investment that's currently under consideration, the evaluation of several mutually exclusive projects. Given your lack of tenure at Caledonia, you've been asked not only to provide a recommendation, but also to respond to a number of questions that are, aimed at judging your understanding of the capital budgeting process. The memorandum you received outlining your assignment follows. So they're saying, to the assistant financial analyst from the CEO regarding cash flow analysis and capital rationing. We are considering the introduction of a new product. Currently, we, meaning Caledonia, are in the 34% marginal tax bracket. So you want to bear that in mind, right? When you are figuring out the tax line um, of your P&L, you're gonna have to do a P&L and then from that determine your cash flow on an annual basis. Um, when you're determining your P&L, your profit and loss statement, you're going to have to use a 34% um, tax provision based on pre-tax income when you come down to that line finally, which is your sales revenue less all your costs. You come up to the pre-tax income, and then 34% of that will be your tax. But anyway, this project is expected to last 5 years, so you got a 5-year time frame, okay? And they're saying that um, because this is somewhat of a fad product, it's going to be terminated after the 5 years, which I think they're kind of just making up off the cuff. But I mean, for purposes of doing a capital evaluation, you want to have a finite time frame, right? So you can determine cash flows for a given time frame, a finite time frame. And here it's going to be 5 years. Okay. Uh, and now they're saying the following information is going to describe the new project. You got an initial cost of 7.9 million. Okay. Shipping and installation costs are going to be 100,000. And then they start getting into some specifics of what they anticipate unit sales to be. For years 1 through 5, you can see that they're going to be 70,000, 120,000, 140. And then they're going to start tailing down in year 4, only 80,000 units, and in year 5, 60,000. The sales price per unit is going to be 300 per unit, $300. So obviously your revenues are going to be the units sold times the sales unit price of 300. Okay. But then they throw you a little bit of a curveball in that in year 5, you're not going to have a $300 per unit sales price, but a $260 unit per sales revenue per unit price. So you're going to have a slightly different one in year 5. You got your variable costs laid out there. They're going to be consistent, apparently throughout the 5-year project, which are going to be, 180 per unit. So you can see the first 2 lines of your profit and loss statement when you start to compile that are going to be based on your sales, right? Your sales units, your units sold. So you got, your revenues, which are going to be the 300 times those units sold, right? Except for year 5, which are going to be 260 times the 60,000 sold in year 5. Okay. And then you're going to have your cost of goods sold or variable costs, direct costs, however you want to describe those, which are going to be 180 per unit. Okay. Then you start getting into some further lines on your profit and loss statement. The next would probably be your fixed costs, which they're saying are going to be $200,000 per year. They're going to be flat right across the board in years 1 through 5. So you're going to have 200,000 of fixed costs, which are like your general and administrative costs, things like rent, things like people's salaries, um, office equipment, all that kind of stuff that's typically, not directly associated with your sales levels, but are more overhead once you establish the nature of your business. Okay. Then they give you some specifics about the working capital requirements. They're saying that there's going to be an initial working capital requirement of $100,000 just to get the production started. So you're going to have a little spike at the very beginning of the project, which is going to be $100,000 of working capital expenditure, basically, just to get the project up and running. Now let's see, for each year, the total investment in net working capital will be 10% of sales. So once you spend the $100,000 up front in working capital to initiate the project, then you're going to have a 10% times the dollar value of sales. Okay, so once you determine what the dollar value of sales are, which is going to be your units times your $300 per unit, except for year 5, which is 260. Once you get your top line revenues or your sales dollars, then you're going to be able to figure out in each year, right? In each year, 1 through 5, how much additional investment in working capital you're going to require to continue to fund the project. Okay. So they're saying thus the investment in working capital will increase during years 1 through 3, right? Because your units sold are are increasing. And then in years 4 and 5, as I mentioned before earlier, they're going to be declining a bit. So the working capital will actually decrease in years 4 and 5. But either way, you're still, and Caledonia is still still spending additional working capital to continue on with the project. Okay. Uh, the depreciation method, apparently Caledonia is using straight line depreciation. So we know that, the 7.9 million plus the 100,000 of shipping and installation, which is also, it's also capitalizable, if that's the right word. You will include that in your grand total of fixed asset additions for this project, the 100. So you got 7.9 million plus an additional, 100,000 of shipping and installation, which you can capitalize. That's all going to be divided by 5, right, to get your depreciation. There's apparently no salvage value here. After the 5 years have expired, so you don't have to worry about deducting any of that from your original capital outlay to come up with a depreciable base. The entire 8 million is going to be depreciable. Okay, so if everybody has the spreadsheet, I'm gonna jump over there. But before I do, wait a minute. I'm gonna just say that what we got here is questions. A, should Caledonia focus on cash flows or accounting profits in making its capital budgeting decision? Should the company be interested in incremental cash flows, incremental profits, total free cash flows, or total profits? Now I'm going to throw it open to everybody here. And let me just get back to our participants so I know everybody who's going to be with us. And I'm going to ask each of you to kind of respond to that first question. Aaron, you're alphabetically first. What would you say to question A? What do you think Caledonia should focus on? Should they focus here? And this is in relation. Let me just preface the question. This is in relation to, or in regard to, really how they evaluate the project and how they and whether they should proceed with it or not. How would you think they should answer that question? Or would you answer that question based on, should they focus on cash flows or accounting profits?
So, from the way I am understanding it it feels to me that they should have a little bit higher priority on cash flows, because in year 4 and 5 we see that I guess sharp decline in units and respectively in sales revenue as well. So if they only focus on accounting profits, they may be in a position accounting wise for reasons where they may be in a good position, but then they realize when they get to years 4 and 5 that maybe they don't have all the cash to continue their operations. So that's kind of my main line of thinking with that.
Yeah, I tend to agree with that. I like your additional thinking there. For me, it's quite simple in that at the end of the day, cash is king, and you can spend cash, and Caledonia will be able to spend cash that's generated, whether it be, to supplement and enhance this project, or if they want to consider other projects, right? So at the end of the day, they're going to be wanting to focus on cash. There's no question on that, but I like your thought as to, what you anticipate happening with profitability for this, for the company related to this project, which is that it will indeed decline. Whether it ends up becoming a loss or not is another question. We're all going to have to lay out the cash flows and the profit and loss statement from which you develop the cash flows. And then I'll just go ahead and jump in on the other question. Should they be interested in incremental cash, which is cash that's over and above the previous year level? and also cash that's associated maybe with this project as opposed to other cash flows from other projects or just the normal operations of the company over this 5 year period of time. So that would be your incremental cash. Um, and I would say yes, for the same reason that Aaron suggested and that I've elaborated on. The incremental cash flows should be probably an important element of all this. Um, and that would be, for the same reason that I'm sorry, for the same reasons that cash flow are probably a little bit more important to look at than accounting profits. Incremental cash flow is equally a bit more important than incremental profit. Um, and at the end of the day, you're going to come to something called total free cash flow, which is the free cash flow is going to include these capital requirements, right? And any salvage value, if there were any. In this case, there isn't any, so we don't have to worry about that. But free cash flow is sort of your bottom line cash, right? From this project, and the free cash flow is the line that you all want to come to before you start calculating things like internal rate of return or net present value or even payback or discounted payback if you wanted to get into all those different metrics of capital evaluation. um, you're going to want to come to a total free cash flow. Uh, and for the same reason, once again, the total free cash flow is key to making a good capital budgeting or capital evaluation assessment. You're going to want to, look at those instead of total profit. So pretty much cash flow is going to be your answer across all um, the different elements of the questions that are associated under Part A. Okay. Um, Next on the list, we got Dylan. Hey, hi, how are you doing, buddy? Um, how would you say depreciation might impact cash flows? Have you done enough research to answer that question, or are you not sure?
Well, the depreciation, I don't know if it would affect the cash flow a lot because depreciation would affect like the asset part of this company,
Right.
not as much the cash flow.
Right.
So, I mean, it could maybe if it like impacted the production of their product, it could impact cash flow, but not necessarily just straight depreciation. It wouldn't affect cash flow, it would affect their assets.
Okay. Um, I would tend to go along with that, but there's a specific reason they included this question, so I'll share that with you and with the class. Basically, depreciation is a non-cash item, right? Depreciation is just an accounting entry. Basically, when a company buys a fixed asset of any size, whether it's this entire project, which is an $8 million project, or if they go out and buy a piece of furniture like a table for their conference room, you're going to be, instead of expensing all that, you're going to be capitalizing it, which is putting it up on your balance sheet and then depreciating it over a useful life. Okay. I know a lot of furniture has like, a 7 year life. If you were buying some office equipment, it would probably have a 2 to 3 year life. Um, Leasehold improvements typically are depreciated over the course of a lease term. So you got a long period of time that you really take these assets and then gradually expense them off the books. Okay. So if you got an $8 million um, capital project here, which is what we're looking at here for Caledonia, then you're going to have depreciation, and this they're saying it's going to be a 5 year period, a finite period that this $8 million project is really going to last for. So you're gonna be depreciating that off the books, off of your balance sheet, and expensing it via the depreciation line over a 5 year period. And they're saying that the depreciation is going to be straight line. Okay. So you're going to take $8 million and divide it by five. to come up with your depreciation expense. But the depreciation expense, when it hits the books, when it's expense, it's going to lower profit, right? Because before we get into cash flow, you have to construct a P&L or profit and loss statement. You're going to have an expense that's associated with this depreciation, and that's going to lower your profit. And as a result, it's going to lower your taxes. So as you expense fixed assets via depreciation over the course of their useful lives, you're going to have expense that lowers your income and thus lowers your taxes. And your taxes are considered cash. I mean, you got, I mean, there's some instances of deferred taxation and stuff, but not here. Okay, the cash outlay is going to be what the company's going to be paying Uncle Sam, each year via the tax provision that we discussed at the very top of the discussion, which is the 34%. So basically, you're going to have a cash benefit due to the increased depreciation expense that actually lowers income. So is everybody sort of understanding where I'm coming from with this concept? Because it is important to the answer to the Franklin lumber case. You'll have the same sort of a question there. So the question is how does depreciation affect free cash flow? And the simple answer to that is that, well, depreciation actually increases cash flow to the tune of the depreciation expense times the tax rate, right? So you with me there on that?
Yeah.
Yes.
Yep.
Very good. Okay. Nina, you good with that? Emiliano, everybody good with that?
Yeah.
Good. Good. Okay. So basically you're gonna have a tax line just like you're gonna have the revenue line on your profit and loss statement. You're gonna have your variable costs, you're gonna have your fixed costs, you're gonna come down to a pre-tax income, you're gonna then have tax. I'm sorry, you're also gonna have the depreciation expense line as well, okay, in your P&L statement. Then the pre-tax, you're gonna affect that at 34% to come up with a tax provision, then you're gonna come back with a net. Okay. Um, and I'll stop there, but all you can probably, very quickly page to the profit and loss statement for Caledonia, the model, the Excel spreadsheet, and see what's going to come next. But let me continue on with the questions because we're sort of going here in sequential order. Okay, Emiliano, what is the product's initial outlay? So in year zero, when they have to spend money to get this whole thing started, what sort of initial outlay are they going to have for this project? Can you tell us based on the information?
Would that be? Sorry, I still haven't had time to read through it fully.
Yeah, first you got the 7.9 million.
The seven, yeah.
Okay. But to that, you have to add the $100,000 of shipping and installation, which, is also going to be an upfront cost associated with this project, right? What else? There's one more component that you're going to have to consider here.
I'm not
Think you
finding
know
it.
what it is? It's the $100,000 change in working capital. The $100,000 that they're saying is going to be an additional working capital requirement. Okay. So you're going to have 8.1 million, which is sort of your total free cash flow or your total expenditure in year what's commonly referred to as year zero. Okay. So let me just switch over here. Okay, hopefully you can all see the spreadsheet now when I'm trying to share this one. So if we go down here to the bottom, you're going to see free cash flow is 8.1 million in year zero. You're going to want to lay this out. The Franklin lumber case, I want to say that's a 5-year project as well. Not positive, but I think so. But either way, you're going to want to lay this out as a year zero. Okay, and then years 1, 2, 3, 4, and 5 for this, specifically for this Caledonia case we're walking through, right? And you're going to lay out the you know, the profit and loss statement here in such a way that, you got your units sold at the top and you got your revenues, you got your variable costs, your fixed costs. You come down to earnings before depreciation and income tax, which is EBIT. Then your depreciation to come down to EBIT, which is earnings before income tax. Then you got your tax provision at the 34%, and you come up with EBIT. Okay. And then if you're depreciate, if you're coming up to a cash flow statement and you've done your profit and loss statement all the way down to EBIT, what are you going to want to do with your depreciation expense below your EBIT line if you want to convert it back to cash? What are you going to want to do with that, Fabian? What do you think?
You want to add it back? So
Attaboy. That's exactly right. Because as I mentioned earlier, depreciation is not a cash outlay, right? It's just a book expense that we're playing around with. So if you want to convert a profit and loss statement you've done all the way down to, the EBIT line or even the pre-tax income line, you're going to want to add income taxes back, right? I'm sorry, you're going to want to add depreciation back, come up with what is referred to usually as an operating cash flow. Okay. So good. Excellent. Okay, so let's continue on with the questions. Bear with me while I get back to those. Going back to sharing this. Just a little image. And we're saying, okay, so what are the differential cash flows over the period's life? Well, we are just looking at them on the Excel sheet that is the answer guide to this. So I'm going to kind of skip past that. The question, what is the terminal cash flow? Well, we sort of know what that's going to be too by looking at the spreadsheet. I can go back to the spreadsheet and show. Yeah, here it is. And share that. We're going to want to go to to year 5, where you see the change in working capital, which is all added back in. They don't spend that working capital. It's just kind of hung up in operations. They recapture all that. And at the end of the day, you're going to have operating cash flow plus that total recapture of prior period working capital expenditure, which amounts to 2.4 million. So you're going to have your operating cash flow, which turns out to be 3,580,000 plus the 2.4. You're going to have a final terminal cash flow number sitting out there in year 5. So let me get back to I'm obviously not so good at sharing these things. Let's see if I can get back to that. Okay, good. So we got the terminal cash. The next question isn't really a question, but it's more kind of a requirement, which is to set up kind of a cash flow diagram, right? So basically, you know what the free cash flows are going to be, right? You know what the year zero initial investment is gonna be, the 7.9 plus the 100,000 plus the additional 100,000 for 8.1 in total. Okay. Um, and then you have your operating cash flow with your investments in working capital plus the recapture at the very end for the terminal value in year 5. You know what your cash flows are going to be, so you should be able to do a cash flow diagram for years, for the project for year 0 up front all the way through year 5. And I'm not looking for anything really intricate on that. You can just do it simply on a paper, just write 0, 1, 2, 3, 4, and 5 right across the page, or set it up on a spreadsheet or however you want to do it. And then just indicate what the free cash flow is for each of those periods. Okay. Just I could determine probably what you mean for your cash timeline, if you will. But if you lay it out just as the free cash flow for periods 0 at the beginning through year 5, then I can see that you're all on top of that. So that would be good. So please do that as part of the project. Let's see what else we got here. Under question K, in capital budgeting, risk can be measured from 3 perspectives. What are those measures of project's risk? And if you flip over to the Excel spreadsheet, I believe that question's answered on your behalf. It'll be part of the Franklin. It'll be part of the Franklin case too, as a question. But basically, we're saying, first there's a total project risk, or the project standalone risk, which is a project's risk ignoring the fact much of the risk is going to be diversified away as a project is combined with other projects that the firm undertakes, right? Second, you've got a project contribution to firm risk, which is the amount of risk that the project contributes to the firm as a whole. So that measurement is going to consider the fact that some of the project's risk will be diversified away, but it ignores the effects of the diversification of the firm shareholders. And then finally, you're going to have systematic risk. So risk the project from the viewpoint of a well-diversified shareholder. This kind of risk that can never be diversified away. It's just like a portfolio risk that you can't diversify away no matter how much you diversify a portfolio. It's the same firm even. Systematic risk is also referred to as market risk, and it is the remaining risk that can't really be diversified away as they combine that project with others, and the same with the stocks in the portfolio.
I have a question regarding that.
Yes.
So you know how when projects are established, they sometimes have like the synergy effect.
Yes.
But you can also establish a project that has like negative synergy effect, so to speak. Would that also be part of one of those risks mentioned, or is that another risk?
Yeah, I think that's probably a different type of risk that would be some form of mutual exclusivity. If you're able to, let's say this project was mutually exclusive, and you were looking at another project, okay, that had a similar time frame maybe, but different upfront costs and different cash flows, different profit and different cash flows associated with it. But let's say, Caledonia could do this $8.1 million project, but let's say there was another 5 million project that they would have to forego, that they lose the opportunity to pursue that. And let's say maybe at the end of the day that that other 5 million project, that make believe $5 million project, excuse me, might be potentially more profitable and might, generate, higher cash flows and might have a higher internal rate of return. It might have a higher net present value. In which case, if you make the wrong decision and it turns out these two projects are indeed mutually exclusive, then that would be a risk. So I think
Right.
that's sort of what you're referring to, but it's really a question of mutual exclusivity.
No, I was more thinking of like, let's say you have a proposal of two projects, and one project is like a standalone project, whereas another project is like a kind of like an add-on to existing products or services.
Uh-huh.
And so that add-on project would then create synergy effects, which might in turn boost like the sales from the original product or service
Okay.
and the add-on, whereas the other project would just be like a mutually exclusive standalone project.
Oh, okay. Okay. Well, in that case, I think you really have to try to include the impact of, on this other existing project within any evaluation of additional expenditure. Okay. So
Right.
let's say we're looking at this project that we're talking about right now, this $8.1 million one. But let's say there's an enhancement to it that might add another, couple $100,000 of profit for each period, or might even add another year of useful life on it. Something like that, which is, I think, what you're suggesting. Okay, so what you would have to do is, find the incremental additional costs of this enhancement that's associated with the $8.1 million project, but isn't really standalone either. It's enhancing, so it's kind of involved with it. That's kind of where you're driving, Fabian. That makes sense.
So I'll try to describe it with an example, if that's okay.
Sure.
Um, I don't know. Let's say you're selling shoes, and then you're also producing laces, which is like the add-on to the shoes, right? So that enhances the shoes, which is like can increase the sales for the shoes, but also you can sell the laces at the same time.
Oh,
And then you have another standalone project where you produce flip-flops, which I don't know, is just shoes itself.
okay. Yeah, that's an interesting question. I think you would have to almost set it up as where you're finding the incremental cash that's generated from, you know, laces by themselves, and then also have a component of additional sales and then eventually converting through cash through the methodology we just used on the 8.1 million Caledonia case. You would have that as well. So you'd have a grand total sort of laces um, product line, if you will. You got the standalone piece plus the piece that's associated with the shoes, and you would have to evaluate that um, in and of itself, and also include in that any lost opportunity costs that are associated with just the sale of the shoes themselves. Does that make sense? I think
Yeah.
either way you got to try to account for everything that you're doing that's going to impact the total company, their profit and their cash. Okay.
Mhm.
And so the answer to your question after all of that, I think is yes, that you're going to have some situations where you're going to have, you know, uh, product production that does impact other product lines or other projects that you really have to try to be comprehensive in evaluating. Make sense?
Yeah. Yeah.
Good.
Thank you.
Yeah, sure, absolutely. I mean, if you want to include that in your answer, that whole idea, when it comes to the Franklin case, I'll be happy to see it.
I'll try.
Yeah, I don't know. I mean, it's not like it's gonna make your answer right or wrong, but if you want to, reiterate that point, I think it's a pretty decent one to make. Um, so we were talking about question L, and then getting into M, they're asking about simulation. You know, how does that impact the evaluation of projects? And basically, see the idea behind simulation. You want to imitate performance of a project. Um, it's done randomly, selecting observations from each of the distributions that affect the outcome of any project. Combining, those observations is going to help to determine the final outcome of the project, and continuing with that process until a representative record of the project's probable outcome is assembled. Um, they're getting into some fancy language here, but basically, the simulation is exactly what the word means. You're simulating a project. You're trying to approximate the results as best you can, um, to reach some output of probability and net present values and internal rates of return results that will be indicative of the profitability and the benefit of conducting a project in itself. We're saying the decision maker then bases his decision on the full range of these different possible outcomes that might come. So basically, you got the answer right there um, on this Caledonia spreadsheet, and I'd use similar language in discussing the idea, the importance of simulation on your Franklin lumber case. And then they ask about sensitivity analysis. It's similar to simulation in a lot of ways. You want to determine how a distribution of possible net present values or internal rates of return for a particular project is affected by a change in one particular input. So let's say, you're interested in knowing specifically um, how does the unit sold volume that they provided. Let's say that all increases by 5%. Let's say it decreases by 5%. Things like that. What is that going to end up meaning for the project? Basically, you're in sensitivity, you're really zeroing in on one element, one particular variable, input variable to the project. You can say, what if the tax rate goes from 34% to 40%? What if our variable costs increase to, by 5% across the board for the entire 5 year? Things like that. You can rerun the numbers by identifying a particular input variable and isolating the impact on that. And that's basically how you're going to get a range of net present values and recalculated internal rates of return that are going to be based on that particular change of input variable. Okay. And let's see what else we got here. They're saying, okay, according to the capital asset pricing model, the CAPM, systematic risk is the only relevant risk of capital budgeting. However, reality complicates this somewhat. In many instances, a firm will have undiversified shareholders. For them, the relevant measure of risk is a project contribution to firm risk. The possibility of bankruptcy also affects our view of what measure of risk is relevant. Uh, yeah, I mean, all that is fairly clear. I hope for everybody that it makes sense that, there's obviously always a potential risk of, you know, bankruptcy or some other major, negative implication that impacts the firm. Because you got to remember here in this Caledonia case project, we're only looking at one small piece of this entire company. We're looking at a potentially $8 million expenditure, and how that's going to generate some unit sales, and how that's going to affect cash flow, and you can evaluate that, but you have no idea how Caledonia is doing as a total company. You don't know what any of their other product lines or projects are doing. So there is potentially a possibility for bankruptcy, or there is, a possibility of, undiversified shareholders that have, tremendous risk associated with being invested only in Caledonia. That maybe they hold a lot of Caledonia stock, or they're, undiversified, or very little diversified. They might have other investments in their overall holdings, their overall portfolio, but they're not nearly as significant as Caledonia. So whatever Caledonia does, as a business, not only just on this $8.1 million project, but anything along the entire company and their business and their operations is going to affect an undiversified shareholder a great deal. But yeah, just when you come to this question in your Franklin Lumber case, you can once again, use some of the same sort of idea and language in your answer, and I'll be happy to read that. That basically takes us through everything. If we look down at, let me just share this again. I think I'm in the right spot. Yeah, so basically, we just go through this again. You lay out your data at the top. You got your cost of plant, you got your shipping, you got your, initial increase in net working capital. You know what the net working capital percentage is going to be. You know what the tax rate is going to be. You know what the required rate of return is specified for this project. It's 15%. You get the sales price per unit. You get the sales price per unit per year 5. It's your variable cost per unit is going to be the 180. What your annual fixed costs are going to be. They're specified as the $200,000 value. What your depreciable life is going to be. Unit sales factor 1. Well, that's just kind of superfluous, really. You're basically given the unit sales, and you get your revenues by multiplying the unit sales times your sales price per unit. So that's just not really terribly necessary to put there. But anyway, yeah. Then if you look at the the income statement, you got your standard design, which is you got your units sold up at the top, but then getting into the heart of the profit and loss statement, you got your sales revenues, right? Then you got your variable. They could add a subtotal there if they wanted to come up with gross profit, but they don't. It's not needed. After variable costs, you got your $200,000 of fixed cost there. You come up with an EBIT number, which is your earning before depreciation, income tax. You got the 1.6 million, right? Each period, which is your initial cost divided by 5. You come up with an EBIT number, which is your earnings before income tax. You tax that EBIT at the 34% rate, and deduct it, and then converting to cash flow, as we talked about with Fabian, you add back the depreciation expense number to come up with operating cash flow, and you continue on to to layer on the initial working capital piece, the net working capital needs throughout the course of the project, which we had discussed earlier, which are a percentage. Um, and you come up with a grand total change in working capital, which at the end of the day is all recaptured, is the 3.5, I'm sorry, the 2.4 million, which is added back. So that all is zeroed out at the end of the day. You're changing net working capital to 100 initially, the 2 million to 1.5 million to 600,000 to 1.8 million negative, all comes to zero when you take the 2.4 million away as being recovered at the end of year 5. Okay, so that all, if you added all those across on line 43 of this spreadsheet, you'd get zero. And I think I even did that. I wanted to make sure that their calculations were right. So that little zero over there off in column J, that's me. I put that in there just to make sure that they were doing this right. And they were. So that's good. So basically then once you have your free cash flow, you can do your present value calculations. You can do your internal rate of return. Is everybody comfortable with how to do net present value and internal rates of return in Excel? Has everybody done that?
Yep, I'm good with it.
Good.
Yeah, same.
Good. Yeah, I mean, because if you're not, just let me know or shoot me an email saying I can lay out an example or something like that. But either way, here, if you go through this worksheet now, which is available to all of you, if you go through it, you'll see how the calculation is done. So you're going to want to do obviously something like this for Franklin once you go through this whole rigmarole, which is to lay out your profit and loss statement, convert it into a cash flow statement, come down to your bottom free cash flow line, and do your calculations from there. But yeah, you got net present value they ask for, internal rate of return, and a modified internal rate of return, um, which you can see, they've laid out there. So if you go to cell C54, you see the formula for this is, MIRR in parens, you got a range, and then you got the C12 is referring specifically to the discount rate and then the reinvestment rate. And they don't say anything about a reinvestment rate being any different than your discount rate. So you got the same percentage for both of those in your MIRR calculation. So yeah, MIRR is always going to be a little bit less. In this case, it's quite a bit less than IRR. And that's because IRR doesn't assume, or IRR assumes the automatic reinvestment of cash flows throughout the project, while MIRR does not. Okay. I'm just trying to think of anything else you might need. I don't know. How does everybody feel about, going into this Franklin lumber case now? Did this help? Was this good?
I feel confident.
Good
Yes, this
session.
helped.
Helpful?
Yep, I'm feeling good.
Good, Aaron. I'm glad to hear that. Everybody else pretty comfortable? You guys? Everybody else?
Yeah,
this helps.
definitely. This will help next week, like using it as a reference for that.
Good. Yeah, I'm glad, Dylan. Yeah. I mean, the whole idea, like I think I've said either in this class or in another one, the other one I teach. Um, it's rare indeed when you don't have resources to look at in real life when you're on a project or you're on a team project. So I'm happy to share examples like this to help people along in their assignments. And I know this is only one case out of the what 5 some odd cases we have this term, but you know if I'm able to help you do better on it because I provided an example, and I'm glad to do so. I mean, that's what we're all here for. So good. I'm glad that you guys have thought this has been pretty good. But I think on that note, we've been here for about an hour, so I think I'm gonna turn you loose. I'm just trying to think if there's anything else. Everybody comfortable with, last time we were talking about, um, liquidity and profitability. Everybody good with those concepts in your discussion board this week and everything okay?
Yeah, I'm feeling good about it as well.
Yep, me too.
Okay, I can't really think of much else. I mean, I know this case isn't really, due until Sunday, right? Or is it due next week? When does this one due? Can anybody look at
I think it's
sorry. I think it's due next week. This Sunday
yeah,
is the discussion
yeah,
board.
it's due a week from Sunday. So yeah, you guys got some time. Yeah. The only thing you guys really have to do this week is the discussion board on the liquidity versus profitability objectives and what are considered more important. So, but yeah, I definitely wanted to go through this. The sooner that I went through this case, the Caledonia case example, in my mind, the better, because it gives you a jump on, preparing your Franklin lumber cases. And that way, I mean, we can maybe talk more about the Franklin lumber case, and, specifics on that on Monday. And rather than beating a dead horse and talking about it again a week from today on Wednesday, maybe I'll just decide to cancel the Wednesday session. I mean, you don't have a whole lot to do, other than this Franklin lumber case. It's coming up a week from Sunday, so maybe if we talk about that again, or this idea of capital budgeting again on Monday, and then maybe I'll just cancel Wednesday. We'll see. We'll see how things go, and if you guys have any additional questions on Franklin, or if it's in too many ways different from this Caledonia case. I don't really think that it is. I think it's pretty much the same series of questions and the same concepts. But I'll leave that for you guys to judge, and based on what kind of questions you might have on Monday. So we'll plan to meet for sure on Monday, and not necessarily on Wednesday. We'll see, and I'll let everybody know on that. So I think I'm going to turn everybody loose. Great job, good job answering questions. I'm glad that this example case was helpful. And if you got any additional questions, don't hesitate to shoot me an email or post to the Q&A section of the board. And I'll get back to you. Okay.
Thank you.
Thank
Thank
you.
you very much.
Thank you.
Okay, great guys. Thanks a lot. We'll see you Monday.
See you. Bye.
Okay, bye-bye.